Wall Street loves noise, ringing phones, red charts, breaking news, confident men shouting predictions they cannot prove. The industry wants you to believe the market is beaten by instinct, experience, and gut feeling. But the greatest money machine Wall Street ever saw did not come from a shouting trader. It came from a quiet mathematician who looked at the market and saw something everyone else missed. His name was Jim Simons. He was not a banker. He was not a stock picker. He was a mathematician, a codebreaker, and eventually the man who built the most secretive investing machine in history. Through Renaissance technologies, Simons built the Medallion Fund, a fund so profitable, so strange, and so locked away from outsiders that it almost sounds like financial mythology. For decades, Medallion produced returns that made normal investing look slow, emotional, and outdated. While Wall Street argued on television, Simons let algorithms quietly harvest tiny patterns. This is not a story about a man guessing better than everyone else. It is a story about removing guessing almost completely. No ego, no hot takes, no hero trader, just data, models, and discipline. So how did a math professor become the billionaire who outsmarted Wall Street? And why did the smartest bankers in the world never figure out exactly how he did it? To understand the machine, you have to understand the architect. Jim Simons was born in 1938 in Massachusetts, long before computers were powerful enough to trade markets automatically. From childhood, his brain seemed built for patterns, not slogans, not status, patterns. He looked at everyday problems and immediately broke them down like a mathematical puzzle. One famous story says that at 4 years old, he wondered why a car should ever run out of gas. Use half the tank, then half of what remains, then half again. In his mind, the journey could stretch forever. That is not how fuel tanks work in real life, but it shows the point. Before Jim Simons understood markets, he understood something deeper. The world has patterns hiding beneath common sense. He moved fast through school. At MIT, he finished his undergraduate degree in just 3 years. Then he earned a PhD in mathematics from Berkeley, while most people his age were still figuring out their first career move. But Simons was not just smart in the normal sense. He had the kind of mind that did not want answers handed to him. He wanted to find the structure behind the answer. That mindset eventually took him into one of the most secretive jobs in America. In the 1960s, he worked at the Institute for Defense Analyses, cracking encrypted Soviet messages during the Cold War. Codebreaking taught him a brutal lesson. A message can look random, but randomness is not always random. With enough data, enough patience, and the right model, hidden patterns begin to speak. That idea would later become the soul of his investing strategy. The market looked noisy. Traders called it chaos. Simon suspected chaos was just a pattern wearing camouflage, but Simons was not built to quietly obey authority. During the Vietnam War, he criticized the official story that America was winning. That decision cost him his classified job. Most people would call that a career disaster. For Simons, it was just a detour. He returned to academia and became chairman of the math department at Stony Brook University at only 30 years old. At Stony Brook, Simons helped build one of the strongest mathematics departments in the country. He recruited talent, raised standards, and surrounded himself with people who could challenge him. This part matters. Long before Renaissance technologies, Simons was already learning how to build teams of extremely smart people around impossible problems. Then came his work with Xing Shen Chern. Together, they developed what became known as Chern-Simons theory, beautiful mathematics that would later become important in modern physics. At the time, Simons was not trying to build a hedge fund. He was following beauty, patterns, shapes, symmetry, structure. The same instincts that later made him billions were first used to chase pure truth. But by his late 30s, something changed. Simons had solved serious mathematical problems, built an academic reputation, and earned respect. But respect does not always pay like the market. So Simons left academia and entered finance. Not because he loved Wall Street culture. He entered because he believed markets were another kind of code waiting to be cracked. At first, he traded like everyone else. News, currencies, judgment calls, human interpretation. And he discovered something Wall Street rarely admits. Emotional trading is exhausting. One day you feel like a genius. The next day the market punches you in the face and makes you question your entire personality. Simons hated that feeling. He did not want to depend on moods, instincts, or narratives. He wanted a system, something testable, something repeatable, something that could keep working when human confidence disappeared. At the time, many academics believed in the efficient market hypothesis, the idea that market prices already reflected all available information, so beating the market consistently should be almost impossible. Simons did not buy it. He saw markets as human systems. And human systems are messy. People panic, people overreact, people repeat habits. Repetition creates patterns. The edge was not in predicting the future like a fortune teller. The edge was in detecting tiny statistical fingerprints left behind by millions of emotional decisions. That was the key shift. Wall Street wanted stories. Simons wanted evidence. Wall Street wanted conviction. Simons wanted probability. In 1982, he founded Renaissance Technologies. The name sounded artistic, but the mission was ruthless. Build a scientific trading firm that treated markets like a giant experiment. The early years were not magic. Models failed. Signals broke. Strategies worked, then stopped working. The machine had to be built through frustration, testing, failure, and painful adjustment. That is what most people miss. The Medallion Fund was not born as a perfect money printer. It was engineered through years of being wrong and refusing to stay wrong. Simons built Renaissance around a different kind of employee. He did not want traditional traders who came with opinions, ego, and old Wall Street habits. Instead, he hired mathematicians, physicists, statisticians, astronomers, computer scientists, people trained to solve problems where intuition usually fails. His logic was simple. You can teach a scientist the rules of markets, but you cannot quickly teach a traditional trader advanced mathematics, statistics, and scientific skepticism. This gave Renaissance a cultural advantage. It did not behave like a bank. It behaved like a research lab, where the market was the experiment and money was the measurement. The first pillar was data, not vibes, not headlines. Data. Renaissance collected everything it could. Prices, volumes, interest rates, currencies, commodities, and eventually strange signals most investors ignored. Before data was easy to download, the team had to physically gather it. Old price records, historical interest rates, market tapes, boring paper that later became algorithmic fuel. That was the truth-telling difference. Most investors looked for the big explanation. Renaissance looked for small, repeatable edges hidden in oceans of historical data. The second pillar was testing. An idea did not survive because someone sounded confident. It survived only if the data said it worked across time, markets, and conditions. This meant Renaissance could kill bad ideas quickly. That sounds obvious, but on Wall Street, bad ideas often survive because they belong to powerful people. At Renaissance, the model did not care who proposed the idea. If it worked, it stayed. If it failed, it died. That is brutal. That is also why it worked. The third pillar was automation. Once the system decided to trade, humans were not supposed to jump in and ruin it with panic, pride, or breaking news. That is harder than it sounds. Humans love interfering, especially when money is moving. Simons understood that the trader's ego was often more dangerous than the market, so Renaissance built a system where the machine had authority, not because machines are perfect, but because they follow rules more consistently than nervous humans. The fourth pillar was collaboration. On Wall Street, traders often hide strategies from each other. At Renaissance, scientists shared code, signals, mistakes, and discoveries. That created a compounding effect inside the company. One person's improvement helped everyone. One person's mistake became a lesson for the whole system. But outside the company, Renaissance was almost silent. No television victory laps, no public strategy explanations, no famous stock tips. The edge stayed locked behind the walls. This secrecy was not just paranoia, it was survival. In markets, once an edge becomes obvious, competitors copy it, crowd it, and eventually destroy it. That is why the Medallion Fund had to stay small compared with the opportunity. If it traded too much money, its own trades would move prices and erase the very patterns it wanted to exploit. This is one of the strangest lessons of investing. A strategy can be brilliant at $10 billion and useless at $100 billion. Size can become the enemy of performance. Simons understood this better than most. He did not try to gather every dollar on earth. He protected the machine from becoming too large for its own edge. That is why, in the early 1990s, outside investors were pushed out. Imagine begging to invest in the best-performing fund on earth, and the answer is no. Most funds want more assets because fees get bigger. Renaissance wanted better returns. That difference sounds small, but it separates asset gatherers from actual performance machines. And the fees were outrageous. Traditional hedge funds charge 2% management fees and 20% of profits. Medallion charged far more, and investors still wanted in. Why? Because after the fees, the results were still absurd. If a machine doubles money faster than anything else available, people will tolerate a lot of pain to stand near it. The Medallion Fund reportedly delivered roughly 70% average annual gross returns over decades. After fees, the net results were still the kind of numbers that make finance professors uncomfortable. To understand how insane that is, compare it to normal investing. The stock market can make people wealthy over time. Medallion looked like it was playing a different sport. But the machine was not magic. It was thousands of small trades, tiny edges, fast execution, risk controls, and relentless correction. Not one big prediction. Many tiny probabilities. That is the part regular investors should understand. Simons did not build wealth by being emotionally certain. He built wealth by being statistically less wrong, over and over again. Every trade did not need to be brilliant. It only needed a slight edge repeated enough times with discipline. That is boring. That is also extremely powerful. Wall Street worships the dramatic call, the crash prediction, the genius interview, the big trade. Renaissance worshipped the quiet signal nobody wanted to talk about on television. This is why Simons was so dangerous to the old order. He proved that some of the market's biggest rewards could go to people who did not even speak Wall Street's language. The traditional investor asked, "What company do I believe in?" Renaissance asked, "What does the data say happens next, just slightly more often than chance?" That question sounds small, but when applied across markets, currencies, commodities, bonds, and stocks, small questions can become a billion-dollar operating system. The scary part for competitors was not just that Renaissance won. It was that outsiders could not easily copy the method. The secret was not one formula. It was the entire ecosystem. Data without talent is useless. Talent without systems becomes chaos. Systems without discipline break under pressure. Simons fused all three into one machine, and he kept improving it. The market changed, so the models changed. Signals decayed, so new signals were tested. The machine survived because it never believed it was finished. That humility is underrated. The loudest investors often sound certain. The best systems assume they might be wrong and constantly check themselves. In 2008, when the global financial system was breaking, the lesson became even sharper. Markets can panic, humans can freeze, but systems built for volatility do not need courage. They need rules. That does not mean machines are invincible. It means discipline must be designed before the panic begins. Once fear is in the room, it is already too late to invent a process. This is where Simons becomes more than a rich investor. He becomes a case study in how process beats personality. Most financial legends are built around charisma. Buffett has wisdom. Soros has reflexivity. Econ has aggression. Simons had something colder. Statistical proof. He did not need the market to agree with his story. He needed the numbers to repeat just often enough. That is less romantic than Wall Street mythology, but it is far more dangerous. Eventually, Simons stepped back from day-to-day leadership. In 2009, he retired as CEO of Renaissance Technologies, but the machine he built kept running. That is another sign of real systems. If everything collapses when the founder leaves, it was not a system. It was a personality cult with payroll. By then, Simons had already made more money than most traders could imagine. His net worth climbed into the tens of billions. But the final chapter was not only about accumulation. Alongside his wife, Marilyn, he poured huge sums into scientific research through the Simons Foundation. Mathematics had made him rich. Then he used that wealth to fund more mathematics, science, and discovery. He supported basic science. The kind of research that may not pay off tomorrow but can change the world decades later. That is patient capital at its highest level. He also helped fund autism research at a massive scale, backing scientists trying to understand one of the most complex areas of human development. Then there was Math for America. Simons understood that if great math teachers left classrooms for higher-paying jobs, the country would lose something more valuable than test scores. So he helped create a program that gave strong math and science teachers real financial support to stay where they mattered most, in front of students. That choice says a lot about Simons. He made billions from mathematics, then spent much of his later life trying to make sure future generations had access to better mathematics. Jim Simons died in May 2024 at age 86. By then, he had already changed mathematics, intelligence work, hedge funds, quantitative finance, philanthropy, and education. But the biggest lesson is not that Simons was a genius. That part is obvious. The bigger lesson is that genius alone was not enough. He built an environment where genius could compound. One brilliant person can find an idea, but a disciplined system can test it, improve it, protect it, and scale it without turning it into chaos. That is why the Renaissance story matters outside hedge funds. Every business wants an edge, but most businesses confuse edge with personality, branding, or confidence. Simons showed the opposite. Real edge is measured, it is tested, it is protected, it is improved. And when it stops working, you do not defend it with ego. You replace it. Lesson 1. Do not confuse noise with information. The loudest voices in finance are often just selling certainty to people who are afraid of uncertainty. Lesson 2. Data beats opinion, but only if you know how to question the data. Bad data does not become truth just because a computer processed it. Lesson 3. Discipline matters more than excitement. The market rewards process over time, but it punishes emotional improvisation quickly. Lesson 4. Capacity is real. A strategy is not automatically better just because more money flows into it. Sometimes more money destroys the thing that made it special. Lesson 5. The future of finance belongs to people who understand both markets and systems. Not just what to buy, but how decisions are made. Simons did not win because he had louder opinions. He won because he built a machine that made opinions less important. He did not outsmart Wall Street by becoming the best Wall Street trader. He outsmarted Wall Street by refusing to become one. That is the brutal irony. The man who beat the market better than almost anyone did not worship the market. He studied it like a code, tested it like a theory, and traded it like a machine. While others chased headlines, Simons chased structure. While others trusted instinct, he trusted verification. While others told stories, he built systems that did not need stories. And that is why his story still feels almost unreal. A mathematician walked into finance, ignored the culture, hired scientists, fed a machine with data, and quietly built a fortune in the shadows. For investors, the takeaway is not to copy Medallion. You cannot. The takeaway is to copy the mindset, test assumptions, respect data, control emotions, and never confuse confidence with proof. Because in finance, confidence is cheap. Predictions are everywhere, but proof is rare. Jim Simons built his empire around the rare thing. He turned mathematics into a trading empire, trading profits into scientific funding, and scientific curiosity into a legacy bigger than money. What do you think? Was Jim Simons the greatest investor of all time, the greatest data scientist in finance, or proof that Wall Street's loudest people are not always its smartest? Drop your thoughts in the comments, hit subscribe, and I will see you in the next one. If you enjoyed the story of how Jim Simons outsmarted Wall Street, then you'll love the story of how Bernard Arnault built the world's largest luxury empire. Click the video on your screen now. I'll see you there.